Hi, good morning. So this is chapter 5 on non-current assets held for sale, and also we're also going to be looking at discontinued operations. Conceptually, really, what we're really saying here is that if users of financial statements are going to be able to make good accounting judgments, we don't want to be holding in the financial statements events that are no longer, if you like, continuing. They're no longer relevant to making future decisions and good decisions about the future. So what we need to do is extract those matters from the financial statements. No one is saying that we shouldn't report on them, so we should report, but if you like, report on them separately, if you like, from continuing operations. And IFRS 5 is really the standard that's been put together to sort of deal with that. So it really looks at in terms of how do we now technically reclassify or classify, so to speak, either just an asset that we used to use, a non-current asset that we're no longer using, or a completely different situation where you have typically maybe a little department or a subsidiary, possibly. And how do you extract not only the related assets in the statement of financial position, but the related revenue and expenses in the statement of profit or loss? And in terms of measurement, we'll look at that and the presentation. And again, I've highlighted that already, that such assets should be presented separately on the face of the statement of financial position. There are generally some updated new rules for the presentation. And again, I've highlighted again that typically we separately report this all in one line. So really, when we dispose of I'm just going to focus on the discontinued operations here. We're going to see it again. When you extract your assets and your liabilities, basically when you dispose of the department, so to speak, you would, as usual, create a disposal account, and you would put everything in there. It's just the same way we would do with any disposal, and then we would sell it. So you might have sold it probably for less than it's worth. Maybe, if you like, I don't know, whatever, Y, and that's bank Y, and so technically there'd be a loss because you've sold it for less, right? So imagine there was 1,000 and you sold it for 500. So there'd be loss of 500, and you'd open up a loss account, loss on sale, 500, and that 500 we would recognize in the statement of financial, in the statement of profit or loss, because it's a loss. Of course, it is transferred to the income statement, but then of course you will also have the associated income and expenses for that year, if you like, and you probably will have something of a profit maybe or a loss or whatever, and all that these two issues will get added together to sort of see what the net effect has been, and must be reported in one line separately on the statement of profit or loss. Right, what are we saying? When we will no longer use a non-current asset for the purpose of trade to bring in, where it serves that definition of what an asset is, if you like, something that, well, you control this thing, and it is as a result of a past event, and we expect future economic benefit to flow in. But that's no longer the case. We're not expecting any more future economic benefit through its continuing use, if you like, through us using it to trade. So what we need to do is to derecognize it from our sort of non-current asset register, if you like, and transfer it into our current asset register. Because what we're really doing is prepping it for sale within the next 12 months. And this is typically the cycle that we would expect, especially for these type of non-current assets, right? And so really, for this to be the case, the following must apply. For us to do this, the asset must be available for immediate sale in this present condition. So that's really the point. I suppose the advantage here really is that, when I say the advantage or the point of this sort of standard is to prevent the failure to depreciate. Because if you remember, IAS 16 requires you to depreciate an asset even though it is idle. So if your intention is to sell an asset, there's no point holding it within non-current assets if you're going to sell it. So derecognize it, because one of the key advantages, when I say advantage, one of the key points about this, once you derecognize a non-current asset and put in current asset, is there is no longer depreciation. So anyway, asset must be available for immediate sale in its present condition, and the sale must be highly probable, meaning that management are committed to a plan to sell the asset. There is an active program to locate a buyer, and the asset is being actively marketed at a reasonable price. So you have scenarios where the directors of the company are asking for 3 million, but really we know the market value is 2 million. Well, I'm sorry, you're not ready. So really and truly, you should keep holding that asset as a non-current asset and keep depreciating under IAS 16, property, plant, and equipment. So what were the conditions again? Classification as held for sale. The sale is expected to be completed within 12 months of its classification as held for sale. It is unlikely that the plan will be significantly changed, so there is a strong intention there to sell this asset. Measurement of non-current assets held for sale. Non-current assets that qualify as held for sale. Yes, so now we've extracted this, and the question here is, I mean, you would expect, right, that we would hold it at its kind of its what's the word? The lower of costs and net realizable value, if you like. That sort of makes sense. You would test it for impairment and see what's going on. So it's currently sitting there at its carrying amount. And it's currently sitting there at its carrying amount. And therefore, what we're ultimately trying to do is to compare that carrying amount with, if you like, its fair value less cost to sell. And whatever is lower, we would leave it there. So, technically the principle of this is a test of impairment, really sort of saying it's currently recognized as carrying amount. Is it possible that it has actually fallen in value by even more? Right. Measurement of non-current assets. So, again, like I said here, this should be presented separately on the face of the statement of financial position under current assets, and we no longer depreciate the asset. So let's look at this quick example. On January the 1st, Michelle bought a stamping machine for 20,000. I'm just going to, if you like, write asset here, 20,000. Expected useful life of 10 years. So therefore, we're looking at a 2,000 charge to depreciation every single year. Nil residual value. On the 30th of September 2003, so that's, if you like, December X1, December X2, September X3. So we've done 2 years and 9 months of trade with this thing, with this machine. Michelle decides to sell the machine and starts actions to locate a buyer. So very clear here. I guess the accumulated depreciation, of course, is 2 years plus. So 2 years, that's 4,000, yes? 2 and 2. And then 9 months, of course, is 9 over 12 times 2,000. I'm just looking for a calculator. I can't see one, but let's just do this. I guess this is 3 over 4, and so this is not too bad, this one. So in 3 into 6, of course, over 4 is 1,500. So we know that's 1,500. So we have a current total accumulated depreciation of 5,500. So currently the net book value, as we stand, 20,000 minus 5,500 is 14,500. That's the net book value. Let's see what the situation is. The machines are in short supply, confident it'll sell. So we can see all indications, all clear indication here that we will be able to sell this asset. Fair value here, market value at the 30th of September is 13,500, but it will cost 500 to dismantle it. So cost of sales, really, or cost of selling this thing is going to be 500. So therefore, the net realizable value, if you like, is 13,500 less the 500, giving you a net realizable value. Of 13,000. So this asset is impaired. So what I really need to do, just pure double entry, is really to recognize an additional expense to bring this thing down from 14,500 to 13,000. I guess, I mean, all I'm really doing is taking everything to a disposal account ultimately, aren't I? And then I can recognize it that way. Just take that out of there. It's no longer in current asset. 20,000 there. 5,500 there, 5,500 here. Recognize the additional expense of 1,500. Expense 1,500, and that's now sitting in there at 13,000. Well, not disposal, if you like, just a current asset held for disposal. I'll just call it that. Yes, and do that. That would be your way of dealing with that. Okay, and that's the so you'll recognize at 13,000. That's the answer. Okay, great. Yeah, it's just coming up to 10 minutes. I think this is a good place to stop with this one, and then I'll carry on in the next video talking about discontinued operations. See you in the next video.